stocks resume their sell-off as bond yields drop on poor economic data, signaling we may already be in a technical recession. The dollar catches a bid as a euro breakdown looks imminent, and commodity speculators get out. All this and more in this week's Macro Insight. So welcome back to Macro Insight, everyone. Today is the 5th of July, and let's have a look at these markets. Okay, last week, bonds definitely caught a bid last week as economic data came in weak, continuing to signal the chances of recession rising. Stocks also resumed their sell-off. We had obviously had a nice, sharp kind of squeeze ahead of quarter end. And the problem with that is it's so well flagged these days what those flows are going to be that everyone starts to position for them early. So we got a bit of an early quarter end rally, and that was actually then met with selling as we got closer to month end, and so we that rally petered out a little bit. Okay, we did see a bit of a relief rally again on Friday though, as a Fed pivot started to get priced in for early next year. Credit markets continue to trade wider, and they hadn't really participated in the rally, quite like equities anyway. So we'd already flagged that as a bit of a warning sign. Dollar-wise, if we look at these charts, we can see dollar-wise, slight bid to the dollar as both sterling and euro sold off around one standard deviation. So you can see these grey bars here are the FXs. Commodities continued to weaken in general. Silver was the worst hit, down about 2 standard deviations, and then ags also took a bit of a beating, but they're not on this chart, I don't think. You know, ags took a beating on the fact that speculators have been parked in that space due to the acute supply concerns, but even though they're taking a beating now, basically, right? So, and you look at some of the fertilizer stocks and things like that are all getting killed as well. Finally, the crypto space retains some downside beta. Unfortunately, it didn't have a lot of upside beta, but it certainly still has downside beta to stocks and trades down towards the low end of the range, but didn't really break through as the Three Arrows capital liquidation proves to be quite far reaching across the whole industry. And, you know, obviously the concerns with the lenders, etc. We'll talk more about later. Okay, so that's kind of the summary of the market action last week. If we then talk about, you know, the major stories, obviously the big one is this kind of recession watch that everyone seems to be on now, right? So, you know, the big data point that spooked bond market certainly was this Atlanta Fed GDPNowcast. So this is like a high frequency thing that they publish that basically takes into account all the latest data prints, and that went down to minus 2.1%, suggesting that we may already be in a technical recession. Yeah, and the technical definition of that is 2 consecutive quarters of negative real GDP. Now, Jim Bianco put out a nice bit of analysis. This is the bottom left chart down here, where he basically looked back at all the data to 2011, and he said this nowcast has never had an error greater than 1.9% if we exclude the pandemic, which is a bit of a special circumstance, right? Which basically means that, you know, this many days ahead of the actual print, it's never had a forecast error of greater than 1.9%. So that's basically saying is the probability that we're going to get a negative GDP print is pretty much 100%, right? So we are going to get a technical recession. That's what he's saying, and that's basically what the market's getting a bit spooked about. Yeah, you know, that realization saw short-term rates, if they're implied by the futures, tank, leaving them pricing in significant rate cuts. And you can see, you know, by rates kind of peaking out in terms of what's implied by the market at the end of this year, early next year, pretty much start of next year. And you can see that's not bad for my hedge. The euro dollar call spread that I put on the back of Mike Green's idea, that's actually doubled in value now. So when I first put it on, those futures went 50 basis points against me, and now I think they're almost 50 basis points on side, right? So that's the nice thing about doing it via a call spread, right? You don't get stopped out by these violent moves and panics. You have that trade on. It doesn't expire till the end of this year. It's priced off the deck 23 euro dollar curve, right? And that could price in many, many cuts if that's what the market kind of thinks, that we've got a recession and the Fed's got to take rates back to zero, which it might do, who knows, right? It's going to price in. So see the top trade spreadsheet for that, for those who haven't already seen that trade. Finally, the data seems to be confirming 42 macro's long-standing view that, we're going to get sharp deceleration in growth into the second half of the year. And that will take us into the deflation regime, right? So if you look at this grid model that Darius puts out, and he put this out recently on Twitter, and you've got the June, July dropping down, and then you're moving in. This is growth dropping down as we go vertically down in this kind of regime thing, and then as you push towards the left, that is basically inflation rolling over, which he sees happening in coming quarters, basically, right? Doesn't think we've quite necessarily peaked just yet. But by the sort of by September to December, that's when you would likely think that inflation is decelerating as well. Yeah. And so far, it's been a bit of a slow motion train wreck in stocks. Yeah. But with growth rolling over, I'd say if the market realizes that the Fed actually can't do as much as is being priced in terms of cutting until, they see some serious movement on inflation, then we may get more of an acceleration basically in this sell-off, right? So that's the question, right? Everyone's assuming that the sell-off in commodity prices is gonna tank inflation. The question is the data basically gonna allow the Fed to do that, right? At what point do they ignore the data and not wait for the data and just respond like the market is basically suggesting that they're gonna do? Remains to be seen, right? There's a lot of people in the other camp that say this time's a bit different until they see evidence of inflation coming down. And unfortunately, the data they look at is lagging. They're going to be a bit late to that party saying, oh, finally inflation's slowing down, but by then it's too late and we're in a full-blown recession, right? So that's the concern that we've got. Okay, so that's kind of what we're seeing in regards to inflation. So on that point about, inflation, Julian Brigden, as I mentioned in the Discord last Friday, Julian Brigden was on Macro Voices, put out a few slides and things that you can have a look at, some of his models. So you can see here, he looks at CPI, just looking back quite far back in time, and saying every time the CPI kind of breaks this band of 5.5%, 6.5%, the sky's the limit, right? It often kind of gets as far as 10%, right? So he's like saying there's no real limit to how far this thing can break higher, right? So he's suggesting that the breakout's not over yet in inflation. He's also got this model based on excess stimulus to try and come up with some sort of forecasting on where CPI tops out. And that kind of suggests the CPI level goes higher. And it also suggests that time-wise, we've still got another quarter or two before it tops out, right? So that's what his models say. They happen to coincide with what Darius's models are saying, right? So you look at 42 macro again, they've got inflation models. They're projecting that inflation isn't peaking for another quarter or two, basically, right? So two very smart macro analysts that obviously I pay a lot of attention to and respect, and they're all calling for inflation to not be done yet, right? And certainly not be slowing down dramatically yet. So even inflation just kind of stops going up and kind of settles around this high level, that's not enough to stop the Fed, right? And then if you look at the contributors to inflation, obviously we've been talking about the stickier parts of inflation showing positive momentum, and you can see it broken down in this chart from JP Morgan Asset Management. And shelter, you've got restaurants, hotels, and transportation. That's been kind of stable, but shelter's obviously ticking up consistently. Whilst you've got energy, vehicles, and food kind of coming down a bit now, they tend to be the most volatile part, right? So because you exclude food and energy for the core inflation numbers, right? Fed's even admitted themselves they've got no control over food and energy prices, right? So as we head into the winter, and with the state of the fertilizer shortage becoming more apparent of what that's going to do for next year, we may get more upside volatility in terms of gas prices and oil prices as well as we head into winter because of Europe's nightmare scenario, all those things. It's not a given that this commodity spike is done and inflation is just going to roll over, basically, right? So we may well be in that 1970s style stagflation environment where, yes, growth is rolling over, but it's not enough to just take commodities to the woodshed and bring inflation down that quickly like they did in, say, 2008, right? So some people are calling for a 2008 style move in inflation as the market gets thrown into recession. I would say the setup in commodities is a bit different this time. So it's not as much of a no-brainer that that's going to happen, basically, right? Yes, we are seeing a pretty wild correction in commodities right now. And so that probably does have some short-term impact on inflation, but like I say, they're volatile, right? We could easily see, what's going on with the European natural gas right now? All bets are off, right? We could easily see a reversal in that. So, okay, so that's kind of it. The two things to really keep an eye on, has inflation peaked yet? And, are we in a recession already? Okay. Now, the big thing we're going to get this week is going to be jobs numbers. So another indicator of, are we heading into a recession? Are we in a recession? Whatever. So the narrative so far has been very much that we've got a strong labor market, right? We've got a robust labor market with a large amount of openings from the JOLTS numbers. And that's the chart on the right. So massive job openings, rising wages suggest very strong demand for workers. Problem is, if you look at some other data like the tech layoff tracker, so I think this is a bit more real time, this is something I saw, I can't remember where I saw it, but basically this is showing you quite a steep acceleration in tech layoffs. The number of companies that are laying off jobs has grown, right? So like 324. And, a year ago, that was like nothing. Right. So a bit of an exponential kind of growth rate in the layoffs there, a little bit concerning, right? And tech layoffs in theory tend to be a little bit of a leading indicator. Yeah. So that's, if there's a recession coming, then that's going to get worse, right? And then that's going to impact some of the headline numbers like non-farms and this. The problem with the JOLTS number as well is that it massively double counts, triple counts jobs, right? You can be advertising jobs in multiple places and they're all considered like separate job openings, which is nonsense, right? So you've got to take some of those numbers with a bit of pinch of salt, basically, right? Anyway, you've got the non-farms data out at the end of the week. That's going to be watched. But like I say, the seasonal adjustments and things like that are make it a bit of a messy number to really look through. We'll see how the market reacts to it, right? But in general, the thing the market's shitting itself about right now is recession, right? And whether or not it's going to start impacting employment. Yeah. What else did we look at? So, and then the last thing, which we've already kind of talked about in previous weeks, is earnings, right? That's going to be the next shoe to drop. So obviously we've had the worst start for US stocks in 50 years, in over 50 years, okay? Cash, bottom left, you can see this is like number of assets with 6-month returns lower than T-bills, which is essentially cash. Right, so that's hit 90%, right? So 90% of other assets are basically done worse than cash. The cash has clearly been king, and we've obviously been cheering for a decent allocation to cash since the start of the year, as have many of the people we kind of pay attention to. Yeah. If you look at the top right chart, we see global tech stocks are now valued like staples, right? So you look at the MSCI World, so not just the US, but MSCI World indices. Compare tech to staples, those valuations have come, from being wildly above, miles above, they've come back in line. Okay. And that's just another way of showing us that, in the price earnings, the price side of things is re-rated, right? And so the next shoe to drop that everyone's concerned about is the E side of things. Yeah. So are we going to see that in this earnings season, right? If you look at the bottom right chart, you see going back to 1967, when we go through these rate hiking cycles, we see the Fed funds rate in these red arrows. When we're raising that Fed funds rate, what we typically see is EPS growth go into negative territory, right? And whilst right now it's still up there, it's heading down, but it's got a bit of a way to go still to get into negative territory. Yeah. So if we're going by that previous playbook of what we've seen through previous hiking cycles, now there are some hiking cycles where you haven't necessarily thrown the market into a recession, but a lot of these do then lead into recession as earnings growth collapses, basically. Yeah. So last week, obviously we had that strong rally coming into the quarter end. Market kind of topped out around 39.50. And then before the actual month end date, we did start to see some selling. And then we kind of started oscillating around that 3,800 area, basically. Yeah. And despite, the JP Morgan put spread collar getting rolled from 100 delta put that was in the money into a brand new put spread collar that's like 50 delta or whatever, that was a net purchase, $7 billion. Didn't really move the market much, right? Because the market had already pre-positioned for all the buying. So at the end of the month, they come in to buy. Well, there's enough people long who are happy to sell it to them, basically, right? So then the market doesn't actually end up moving, right? And a similar story with the pension fund rebalancing flows, right? There would have been a decent amount of buying, but it got soaked up by the fact that everyone bought it ahead of time and planned to offload it into that window, basically, right? Anyway, the S&P kind of found a bit of gravity around the 3,800 level into the end of the week. And it did have a bit of a rally on Friday, as I mentioned, because market took, even though the GDPNowcast tanked and bonds responded accordingly, equities took that as a net positive because that takes some of the hawkishness out of the rates market, basically, right? So we're still in that bad data equals good data and good data equals bad data world at the moment. We may shake out of that, and it might be bad data is bad data as well at some point, particularly on the earnings front. I'm sure it will be. But in terms of economic data, people are still giving the benefit of the doubt that the Fed might be able to pivot, right? And we're just not too sure about that yet. Right? We look at euro. So we already said, dollar caught a bit of a bid, but basically euro sold off, unable to hold that 106 level. You see that little bounce. So it's in this long-term downtrend, unable to really hold at 106. And kind of swings back lower. Credit markets in Europe have been gapping higher. So you can see the iTraxx main here. We've got iTraxx main relative to the V stocks, which is the vol of the Euro stocks index. It's kind of like the VIX equivalent for Europe. And iTraxx is just going nuts, right? So clearly, credit markets in Europe are pricing in quite a lot of trouble down the road on the back of what's going on with Europe and what's going on with, gas prices and a looming recession there, basically. If not, we're probably already in one, right? So this is what the iTraxx main is kind of sniffing out, whereas the equity vol market doesn't seem to care that much, right, on a relative basis, right? So, there may be a catch up there, and European vol does start to spike. Certainly, if we break that level on the DAX and we start to get acceleration, then that may be the catalyst that European vol needs to catch up, right? But then the other chart here is Germany's trade balance, right? The fact that it's gone from massive trade surpluses to literally now negative 1 billion in like no time at all due to the energy problems and the weakness in manufacturing, right? And obviously the fact that they export cars and things like that. That's a bit of a shocking scenario, right? You see that it's a pretty dramatic sell-off in their trade balance. And that typically, explains some of the euro weakness that we're seeing. Yeah. Now, the major support level for euro is obviously 103 and a half. It's having a go at that today, basically. I mean, I'd written in the report that it feels inevitable that we're going to get a downside break, but literally we may be getting one as we speak, right? So, but if I bring up the live euro chart, we can have a look at it, see where it is. But this is a monster level, basically, right? So, it's held it a few times. It's tried to hold it a few times. If that level goes, and this is like a long-term channel that I've drawn out, right? That's kind of your last level of support, right, on that long-term channel. If that goes, maybe you get some support at psychological parity level, but to truth be told, I mean, that opens up the way to the bottom of the channel, right, which is 90 cents. So quite a lot of potential weakness in euro, I would say, right? And naked puts in euro, which I still have some of, obviously in the top trade spreadsheet. I didn't take all of them off, but even still, I mean, they're on like 12 vol or something like that, right? So if you really think this opens up the way for a proper move down, I still don't think they're overly expensive, right? Because these things can trend, right? And then lastly, on commodities, the kind of speculative positioning and what we've been seeing there. So this is a CFTC report put out by the Saxo guys yesterday. And they're saying that, we're obviously seeing a loss of momentum in commodities on these demand fears, recession fears. and speculative length is just getting shipped out the door across the whole complex. Okay. Obviously, commodities have been a relative standout performer across asset class. So people were parked there, and now people are saying, get me the hell out of there as well, so I can get to keep some of my money, right? You know, even some shorts are being increased in the metals, right? So most of the commodities are still net long, except for the metals, where you've got platinum, palladium, and copper in shorts territory. And copper's the biggest short, basically, right? So people kind of leaning on copper as a bit of a macro recession hedge, and they're actually short. Obviously, I've been short copper. I told everyone, I told subs that I've covered it yesterday at around 355. I think it's gone a little lower today. But in general, my target was around that 350 area after we broke below 390. We had a quick 10% slide. I'm happy to bank that one. I'm still long on a longer term basis. That's a 3 to 5 year view. That's going nowhere. But now I've had the tactical move that I was afraid of. Given how oversold it looks, given that the spec shorts are in, maybe there's a bounce coming. If there's a big enough bounce, then I might think about reshorting again from a tactical perspective. But for now, I've kind of played the move as I wanted to, and I'm kind of happy with that as it is, basically. And then the only other thing to mention would be silver. Like we said, it's got beaten up. It has had some de-risking as well. Pretty decent move in the CFTC positioning, kind of going to about flat. Silver wise, you know, I'm light on silver. I do believe in it longer term as a bit of a gold kind of, you know, if you like having a bit of gold in your long-term portfolio, then there's no reason why you shouldn't be happy to have a little bit of silver as well, but obviously vol adjusted, beta adjusted, right? But I don't think there's a rush for that. I think silver has the potential to get as low as 18. If you look at it, it's at 19.5 now. You look at the kind of levels, obviously that was a bit of a level, 19.5, that previous resistance. Bounced off it, but is heading back there again. For me, but until we get to that kind of 18 area, I'm not touching it, basically, right? So, you know, then I'll probably dip my toes in for a bit of long-term exposure, and I'll leave myself some dry powder to increase it as it goes lower, basically, maybe down at 16, I'll do another clip, right? But for me, yeah, I lightened up on silver a long time ago. I'm glad I did, because I wasn't particularly bullish on gold, and I just thought silver would get battered alongside on a higher beta. So yeah, I think it's okay to start dipping your toes in, but I'm personally not. I'm waiting for 18. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.